Halfway through 2018, middle market executives continue to display strong growth, ambitious investment appetites, and aggressive hirings. As their companies do well, though, there are also glimmers of anxiety as executives look at trade policy and costs. The National Center for the Middle Market tracks mid-sized companies' performance, the growth, plans, and challenges of the market that moves America. To check out the latest middle market indicator, go to this URL. I'm Tom Stewart, the Executive Director of the National Center for the Middle Market at The Ohio State University Fisher College of Business, with the latest numbers from the Middle Market Indicator for the second quarter of 2018. The Middle Market Indicator, the MMI, is a pulse check for companies with annual revenues between $10 million a year and $1 billion a year. This is the middle market. It accounts for about a third of private GDP and private employment. The data I'm about to talk to you about were collected in the first half of June 2018. When it comes to growth, the middle market is rocking along. The annualized growth rate of middle market companies was 7.4%. That's down a tad from the first quarter, but it's substantially higher than the 6.7% recorded at this time last year. Now, it's also, for the first time in half a dozen years, a little bit lower than the growth rate of the S&P 500, which was 8.2%. One explanation for that could be the effect of currency. The dollar, or the euro, is a little bit higher vis-a-vis the dollar than it was at the beginning of this year, and so companies with substantial overseas earnings, including the S&P 500, might see that would inflate their revenue numbers. Now, in the middle market, just about everybody's doing well. 72% of executives say that their performance improved last year, which is tied for the record in the last 7 years of middle market indicator history. Peering into the immediate future, we asked companies about their order books. What's in the pipeline for the months just ahead? 43% say their new order pipeline has increased since a year ago, and among those companies, the average increase in orders is more than 12%, 12.3%. Both of these are the highest numbers we've ever recorded. Asked to predict sales for the next 3 months, 55% say they'll be higher, and just 5% say they'll be lower, which is an 11-to-1 ratio. So business is good. It's very good. Construction companies are thriving particularly well, having grown at a 10% annual rate. Financial services businesses are close behind. Retailers and wholesalers are lagging a bit, but still had solid revenue growth. If we look at hiring, construction companies, the biggest top-line growers, were also the biggest hirers. They added jobs at an aggressive 10.5% clip. And surprisingly, retailers were not far behind them. Overall, job growth in the middle market was extremely strong. Over the last 12 months, middle market companies collectively have increased their payrolls by 6.7%. Now, this is the seventh quarter in a row in which the middle market has added jobs at a faster than 5% annual rate. And for as long as we've been tracking these numbers, we've seen that the middle market, mid-sized companies, are far and away the most robust source of new jobs in the U.S. economy. Now, looking ahead and projecting hiring, mid-sized companies are also seeing a very rosy picture, or a very aggressive picture, when it comes to hiring. The upper middle market, companies with revenues between $100 million and $1 billion, are particularly hungry for talent, forecasting hiring that's 20% higher than the market as a whole. Now, given the low unemployment rate nationally and the fast pace of hiring, it's no wonder that middle market companies put talent tops on their list of long-term challenges. What are middle market companies doing to attract and keep people? Well, we've noted before that wages and benefits are starting to go up. We've also noted that companies are investing more in training and development. As one executive told us, if you can't hire the people you need, you have to grow them. Another trend, incentive compensation. 47% of companies are offering additional incentive compensation, which is a third higher than what we saw in the third quarter of last year. The hiring data show us something else too. In the last year, payrolls in the middle market went up nearly as fast as revenues, 6.7% for payrolls, 7.4% for revenues. That suggests that there could be productivity opportunities. A well-run company, you'd think, would see revenue grow substantially faster than employment as it added capital equipment or changed processes to become more efficient. It's hard to know why this doesn't yet show up in the numbers. Maybe it will in a quarter or two. So strong growth, strong orders, strong hiring, but the second quarter middle market indicator is also flashing a signal of strong concern about the direction of trade and trade policy. The MMI measures executives' confidence in local, national, and global economic conditions. All three declined this quarter, with confidence in the global economy dropping the most. Now, they all remain higher than they were a year ago, and one quarter's jiggle isn't a trend, doesn't constitute a turning point. But a dip in confidence is more than of psychological significance. Confidence motivates executives in decisions about expanding, investing, innovating, and hiring. Now, it's not hard to find a cause for the anxiety. 10% of middle market executives are concerned about the cost implications of tariffs. That is 5 times the average of the previous 3 years. There's also a jump in concern about costs for raw materials. Now, the data reported in this second quarter of 2018 MMI were gathered during the first 2 weeks of June, at the beginning of what appears to be a U.S.-instigated global trade war. Just before the survey went out, the U.S. imposed tariffs on steel and aluminum from Canada, Mexico, and the EU. They reciprocated with tariffs on baskets of U.S. goods. A month later, in early July, the U.S. hit China with $34 billion in tariffs, which struck back tit for tat, and talk of tariffs has continued to rise. So, not surprisingly, wholesalers are the ones who are most anxious about trade conflict, since they would have to deal with tariffs both coming and going on both exports and imports. 33% of wholesalers say they worry about the impacts of tariffs. Manufacturers clock in next. 12%, 1 out of 8, are quite concerned about the impact of tariffs. And manufacturers, too, might find that tariffs affect them in both directions, going out with intermediate or finished goods and coming in with raw materials and components. Now, as of today, we cannot see that trade or other issues are causing wallets to close. There's no diminution in the number of companies saying they intend to expand globally. It's 20%, roughly the same as it has been for many quarters. We don't see a change in overall investment appetite, which remains at just about a record high level. But these are numbers to watch. For now, though, with a very strong 6 months in the book and bright prospects for the immediate future, executives in the middle market are doing well and feeling good. But the market that moves America is keeping an eye peeled. For more information about the middle market, visit our website, which is middlemarketcenter.org. There we post the entire middle market indicator, the data I've summarized here, the full report, and also, if you want it, the raw data for this and all previous MMIs. There's no cost to that. You'll also find, in addition to the MMI, lots of other research from the center about such topics as mergers and acquisitions, managing talent, patterns of growth, cybersecurity for middle market firms, and much, much more. That URL again is middlemarketcenter.org. For the National Center for the Middle Market, I'm Tom Stewart.